Nigeria stocks weakened 0.12% on Monday as the pessimism that marked the previous trading session impelled investors to offer huge volumes of shares for sale. Jitco, Nigeria's biggest bank by market capitalization, and cement maker Lafarge, WAPCO, were at the forefront of retreat, with the industrial index contributing most to the downtrend at the sector level. There is no definite end in view to the dramatic comeback that's talking about a dramatic comeback in the near term for the market that has lost 5.06% so far this year. But the central bank's resolution to hold benchmark lending rate at for the fourth time holds some promises, exactly some meaning for the pace recovery will be at best be measured and steady. At the deadline for the release of banks' earnings reports draw near, now investors will be on the lookout for results of the big five banks, hoping strong performances from them will turn around the fortunes of the bourse. Well, I introduced him earlier. He is the head retail investments at Chapel Hill, Denham. Mr. Ayodeji Ebo. It's good to see you, Mr. Ebo. Good afternoon.
Good afternoon, and thanks for having me.
Yes, I was stunned when I saw this morning. Equities, there was a loss of 25 billion at the stock exchange just at the end of trading yesterday. Give us an overview. What's responsible for this?
Okay, thanks. I think what we're seeing, you would agree with me that we've seen a bit of improvement, traction in the last few weeks, before last week, and that was due to the inflow of positive earnings, which boosted investors' confidence. You will look at it across the industrial goods sector, the telecom sector, even the agri sector, and even when you also look at some of the fast-moving consumer goods, their results were positive. So that spurred interest in the market. And typically, it's always like a cycle. When you see during earnings season, depending on the performances of most of the depending on their financial performance, you would see interest in some of the stocks. Some of the companies even paid interim dividends, which is also attracted investors. So we're beginning to, there's been a wind down of the earnings season, which means expectation is lower. And most times what you find is you see less demand. And once there's less demand, because the market's the demand and supply, there's a tendency that you see market dropping downwards. Because if you also recall, part of the major drag to the market was even the fixed income. But we've been seeing interest rates also go lower, so which is positive for the equities market. So what we would see, like we mentioned, the top five banks that were expecting their earnings, we believe that just in line with what happened when we saw very impressive earnings, we would also see that market react to those positive earnings when we begin to see the top banks release those results. So by and large now, it's as a result of expectation, and the market is basically more for long-term investing at this current level. So you see the likes of GT Bank when you check the price to book of GT Bank at 1 times. When you look at the historical, most times around 1.8, almost 2 times. So it shows that there's an opportunity to come into that particular stock, but that's meant for medium to long-term investors. So we believe that yes, market is a bit on the downtrend. There's really no major catalyst to propel the market, but we believe that as we also get into the Q3 earnings season and investors can see that companies are consistent in terms of their positive performance, markets should also gain more traction again, which will take it up to the end of the year as early bird positioning begins ahead of full year results and corporate actions.
Okay, before I go to issues around policy changes and other affects investors, we also see this report coming from the CEO of the Nigerian Exchange Limited, Mr. Yomi Pupola, saying that the value of its securities lending market is now as high as 513 million naira as of August 2021. What positives do you see this having for the market with regards to liquidity and all of that?
Sorry, I didn't get that. The value of lending.
The value of securities lending markets rose to 513 million naira as of August 2021.
Okay, thanks. I think that's a very positive development, because what happens if you just to put a bit of breaking down what securities lending means is that you have the assets, but you have someone that needs that asset, and you borrow the person the asset and you earn a return. So rather than keep your asset and just be waiting only for dividend, is providing opportunities for long-term investors to use those assets to also earn return. So with that number, I believe that there's a lot that is being done in terms of investor education, so that investors are comfortable to borrow, to lend someone their asset and to get something in return. So I believe our market is, in terms of the scope, is expanding. We also know the derivative, some derivative have been listed. So as we progress, that would add to the activities, and investors will be able to take different positions on some of the stocks, be able to make use of existing unit and create activity, because what you see in developed clients is that they create activity on the same stock. So some can go short, some can go long, some you are trying to create, you are trying to lend someone your security for a particular amount. So that will even encourage investors that are going long and have significant volume. While they are waiting for dividend, they are also able to earn a return on their security.
Thanks for that clarity. Thank you very much. Now, let's now assess investors' confidence with the array of policy changes, of course, in the financial space. A lot of policy issues. How is this affecting investors' confidence at this time?
Yes, I think the number one thing, we know that investors don't like uncertainty. And as long as we continue to see in and out or inconsistency in terms of policy, it's a red flag to potential investors, and because it sends a very negative signal. And you can also even look at our foreign direct investment. You can see that it has declined significantly. So I think it's around $300 million if you look at for this year. So it's policy inconsistency has a very negative impact on investment. And I believe some of the policies that is being introduced I think it's just the approach that I feel we may also want to consider. What will be the overall impact? Maybe some may not be openly disclosed, and you still deal with the same issue so that it doesn't affect confidence. Because most times you say when confidence is lost, it's very difficult for you to gain it back. So I believe that even the regulators will also be looking at maybe the best approach in terms of trying to introduce some of these policies. But I must say that it's good to have regulations, and most of these regulations that are being introduced is to protect the investors, is to protect the customers. And when you don't have regulations, you see a lot of ingenuine investors taking advantage of the market, and at the end of the day, most people will still point out hands to the regulators that they are not doing their work. So I think we'll just need to balance it. It's critical that we need to have those policies, and for any new startup fintech, they should also try to see where they want to play and ensure that they have licenses that guides them around that.
Now, the deadlines for release of banks' earnings reports is also drawing closer. Investors have their fingers crossed on this, of course. What should they be expecting? We've talked about the 5 big banks.
Thanks. I think for us, we're very bullish on the results, and our reasons are when you firstly you look at the interest rate environment, it has improved. Last year it was almost near zero. So even for the banks, they will be earning more. Also, you also want to look at the impairment charges. In addition to the forbearances that most of the banks also got, you will discover that about 30% of the loans goes to the oil and gas sector, especially you look at the upstream sector. Oil prices have improved significantly from last year and even from last quarter. So it means that a lot of there will be a bit of significant write back on some of those loans that were not performing in previous quarter or in corresponding quarter last year. So we believe that it's going to be positive. We believe that most of these banks will also retain minimum the past interim dividend, though there's been conversation around, it's not been confirmed by management that due to the cost of the change, the structure to GT code, that's Guarantee Trust Holding Company, they may likely not pay dividend. This has not been confirmed by the management, but it's still a bit of speculation. So it means that it will be a major plus if they are able to pay interim dividend, because market has already factored that into the current pricing. So for us, we are bullish on the banks, but anybody coming, any investor looking at the banks now should also have that long-term horizon. We believe that with business activity also picking up, the banks are also seeing new avenues to lend more even to the real sector. I know there's still that risk of the third wave of COVID-19, but we believe that with vaccination, the impact won't be as much as what we saw last year.
Now, the market that has lost as much as 5.06% so far, and this year we are already in the 8th month. So how long do you think this will go on before it beats a retreat? Do you see anything changing anytime soon with the current situation even across the economy itself?
Okay, thanks. I think the first thing we should note that the market structure in terms of activity has changed. So currently, when you look at the ratio of foreign activity to domestic activity, domestic activity has been dominating with close to 70% or over 70%. So that reduces the volatility in the market. And if with what we're seeing, the sustainability we're seeing that we've been seeing, or the reduced, if I put it this way, the reduced volatility we're seeing in the market, which is being supported by domestic participation, if there's more clarity around the FX, around the market, it means that by the time we begin to see influx of foreign investors in the market, that is a potential that will lead to significant upside. Even the institutional domestic investors are not playing as much as we saw last year because of the higher interest fixed income rate environment. So which is also going to be a plus with what we're seeing in the fixed income market, with the drop in rates, that would also be supporting the equities market. So still there's still potential within the medium to long term. Or if we look at it before the end of the year, we always see that rally as investors position ahead for corporate action. So investors would recommend investors to have that medium to long term time horizon if they are looking at this market. The yield, look at stocks that will give you yield between 8 to about 10%. That is also that can compete favorably with the fixed income market. So it's always balancing your portfolio, depending on your risk appetite or investment objective. Look at the percentage you also need to allocate to equities, because beyond even the dividend yield, which is a conservative view, you also have that capital gain opportunity, which overall will compensate you for the risk you are taking by investing in equities.
Well, we now expect a steady recovery rate. Well, that's not coming from figures from what we see from the CBN's resolution at the last MPC meeting, and even from the fiscal side, we see this positive, this optimism ahead of recovery and growth, even as we expect GDP figures to trickle in. Do you think this will have any effect on the markets? Are investors thinking along that line? Are they also optimistic that that growth, that projected growth, will be achieved?
Yes, I think investors are expecting that the growth will be very positive. And when you look at it on a base effect, Q2 last year was negative 6.1%. And on a base effect, we expect that it should come in around maybe 4%. But if it comes significantly lower than analyst expectation, we may see a bit of sell-off in the market because of their reaction to the figures. But we feel with what is happening, business activity is picking up. Yes, despite the increase in the spread of COVID, it's not affecting business activity. So on the back of that, we are positive that the expectation, the GDP numbers should meet expectation, and investors will be able to price that in. And if it surpass expectation, we should also see that reaction in the market. But we know those major drivers, drivers in the market in terms of the foreign investors, the domestic institutional investors are currently not playing significantly in our market. So as a result of that, we believe that their participation would also spur the market. Though there's a view that for some of the foreign investors, once they get a bit of clarity or they get more allocation on the FX, you may see a bit of sell-off, but we don't expect that to be very significant based on their participation in the market. Investors, especially domestic investors, once they begin to look at stocks from a dividend yield perspective and those stocks decline and they can see attractive dividend yield, would see a bit of pickup or investment in those stocks, and as a result will also bounce back.
Now we've seen this negative performance. Before I let you go, Mr. Ebo, we see some say it's in regards to profit taking, and that's what has caused some of this, and you know that sentiment in the market. But according to you, when you look at this, the insurance sector seems to be excluded from when you talk about profit taking. What is driving this behavior at the exchange? That's one. And what other sectors do you think we should look at moving on in 2021?
Okay, thanks. When you look at the insurance sector, we know they've been on this subject of recapitalization, and there's been a lot of capital injection going on in companies or capital reconstruction going on in a lot of the insurance companies. So that is also helping to sustain the prices. So what you're seeing may be strategic buying by some investors, and as a result, the prices of those stocks are being defensive. But if we're speaking to some of the sectors that we feel would post very strong performance even going into the year, I will start with the telecommunications sector, which is a no-brainer. So we all know there's an increase in the usage of data and voice, and there are those companies that are well positioned for that. And even now with some of the strategy they have to reactivate or to link the NIN to some of the numbers that have been inactive, we expect that would also increase their revenue going forward. You also see the cement industry, or what we call building materials sector. You would discover that what we've seen is a sustained demand because of construction activities, and we believe that would also be sustained to the end of the year. And lastly, looking at some of the FMCG companies, you would see that for some of them, because of what they sell, the demand is inelastic. No matter the change in price, people still buy some of those goods. So as a result, we will see that they will also be able to sustain their top line in terms of sales. So by and large, we know in terms of global outlook may look a bit bleak, but when you look at some of the companies, we believe that they would be able to sustain that performance. And as the global outlook in terms of the new variant of COVID clears out, then we'll also be seeing a bit of upside in some of the companies quoted on the Nigerian Stock Exchange.
Now let's wrap up with expectations from the fixed income market as the NT bills, Treasury bills, we expect primary market auction is set to hold, I think later this week.
Yes, I think it's holding today for the NT bills.
Okay.
No, it's holding, that's tomorrow rather.
Tomorrow, Wednesday, right?
It's holding tomorrow for the Treasury bills primary market auction. And we expect that at the longer end, because the 91-day and 182 days have remained sticky at 2.5 and 3.5% respectively, we believe that we would also see a bit of a drop at the 364-day instrument that closed at 7.35 at the last auction. So we're expecting something around the 7%, and due to the high liquidity, or maybe at sub 7%. Yes. What we feel that this would be positive for some of the corporates that are looking at coming out at this time.
Well, it's a good way to live. It's always interesting having you join us on the show. Head Retail Investment at Chapel Hill, Denham, Mr. Ayode Diebo. Thank you very much and do enjoy the rest of your day.
Yeah, thanks. Always my pleasure.